Wonderful, wonderful. Well, good afternoon, everybody. Thank you so much for joining us today. My name is Laura Nieves. I'm Head of Investor Relations here at Astor Realty Capital, and it is my pleasure to welcome you to our May edition of the Astor GlassDoor Portfolio Review. At Astor, transparency is one of our core values, and this webinar series is a cornerstone of our commitment to keeping both current and prospective investors fully informed. For those of you who may be joining us for the first time, Astor Realty Capital is an institutionally backed private equity real estate firm. We have offices in Manhattan, Miami, and Tel Aviv. We specialize in value add and ground up development opportunities across major US markets. Our portfolio today stands at a strong $3.3 billion in real estate asset participation and includes more than 4.7 million square feet of commercial and multifamily property. We're proud to say that at Astor, our consistency of achieving returns that surpass industry averages is a direct reflection of our experienced leadership, disciplined underwriting, and active portfolio management. Our mission is simple yet powerful. At Astor, we believe in breaking traditional boundaries by leveraging our collective bargaining power. We're dedicated to leading our community of investors towards financial security and growth with integrity, authenticity, and transparency. For us, it's not just business, it's personal. So tonight, this is a session that's going to be hosted by our CEO and founder, Joe Berko. Joe truly embodies the mission that I just said a few minutes ago. Joe, many of you may know him as Yossi, is a highly respected entrepreneur with over 25 years of experience in the real estate industry. Under his leadership, Astor has participated in more than 26 ventures across 12 US markets, contributing to our 4 million square feet of development and placing Astor at the forefront of the private equity space. Joe, over the course of his career, has been widely recognized for his creativity and leadership in deal making, and he's earned himself accolades such as Power Broker by CoStar and New York Signature Broker by Globe Street. So in tonight's session, Joe is going to not only take you behind the scenes of how Astor continues to drive investment success across our $3 billion portfolio, even amid the shifting economic conditions. He'll be discussing the impact of recent rate cuts, the rising importance of private real estate in today's investment landscape, and how our strategy continues to adapt in response to one of the most macroeconomic topics of the year so far, and that is tariffs. Now, why are we talking about tariffs? Because they do matter, and according to CBRE, tariffs can reduce overall consumer spending power, delay leasing activity, and increase inflation, all of which have ripple effects across the commercial real estate industry. But it's not all downside. Over the longer term, tariffs may also contribute to a revival in the US domestic manufacturing industry and potentially lead up to 4,000 new jobs, creating fresh demand in the industrial space, especially. So these are just some of the dynamics that Joe's going to dive into today, and we at Astor constantly and actively monitor and respond to as we continue to refine our strategy, protect investor capital, and position our investors for long-term gains. So along with Joe tonight, we have Alex Mulcahy. He is one of our senior analysts. He'll dive into and share further insight into our market data. So on that note, I am going to pass it over to Joe to lead us through today's discussion. So Joe, over to you.
Wonderful, Laura. Thank you very much. And always happy to be here. I also want to acknowledge some of the other team members. Marika, who is the COO, Andrew Milbank, who is Chief Investment Officer. We have Sebastian Lacayo, who joined us fairly recently, been with us for a while, both as an intern, as now is working very closely with Marika and Laura's team on origination. And Laura, good to have you back. We're really
Joe, we lost you for a second there, but very glad to be back.
Thank you.
Yep, you're back.
We're going back to this periodic conversation, what we call so available for any question. But this is an opportunity for us to sort of like share the information and offer it to everyone else who's here. So we have not just our investors, but also individuals that have been looking into Astor, have been thinking about or have been waiting to invest with us. So again, welcome all and thank you for joining. Let's just dive right in. We can put it up, please. The presentation. Alex has worked on it very nicely, put something very nice for us. So let me see, controls. Okay, beautiful. Snapshot, Astor Realty Capital. The collective experience, at this point, I would say we're more than 65 years of collective experience. But if you think about the overall experience of the executives, I alone have about 30 years of experience, started in the real estate industry in 1995. Andrew has been with us for about 12 years. Laura's been with us for about 12 years. Alex Mulcahy has been with us also for about 6 years, maybe a little bit more. Marika has been in the real estate industry for almost close to 10 years. So I think the number is larger than that. And we sort of like give that as our collective experience. Top 12 performing markets. These are markets that are growing both with jobs and employment, markets that are dynamic and have a general population of around 38 years old. And that's an important number for us. Like Laura mentioned, around $3 billion in overall real estate portfolio mark to market. So since we do a lot of construction deals, we look at them as stabilized, and then we do a count to see sort of like where things are. From inception, we've raised $167 million, and that for us generates a mark-to-market to $281 million that we're managing right now. 4.7 million square feet of gorgeous real estate across those 7 states and 12 various markets, over 3,600 units, and averaging across all strategies. We'll talk about the strategies in a moment, around 22.3% with, I'm happy to say, 0 losses. It is not to say that we don't have some challenging projects, we do, but we have 0 losses of capital to our investors. If we look at the count, 38 transactions from inception, joint venture equity transactions, we have 18, $75 million invested, $70 million is first, almost $71 million is projected in profits. generating a total of 26.5% average annual return. So our JV equity today, according to this quarter, 26.5% average annual return. Preferred equity, this is those positions that are taken sort of like a hybrid between equity and between debt. Preferred equity positions, very popular preferred equity positions. We've made 14 to date, $88.5 million invested, generating $41.5 million for a total of 19% average annual return. This is Astor's return. And then, of course, our investors see a little bit less because we participate in some of the profits. And on debt positions, to date, we have only 6 debt positions, just shy of $4 million, averaging 16.7% annual return. Averaging all of this combined, we're looking at 22.3, and it changes every quarter. Depends on new deals that we onboard and so on. If you look at the inception of the company, we actually started in 2015, but we're sort of like, putting it together 2016 until now. You can see kind of like the activity. Give you some indication. Typically, on a good year, we'll do around 6 to 7 deals. In some years, tougher years like 2020, we've done, I think, 1 or 2 transactions, if at all. 2018, we've done a little bit of transactions. 2023 was a softer year. And of course, 2024 is starting to pick up. This year, I want to say that we're working on larger transactions. The focus is again, on the same strategies, a lot of preferred equity strategies that we're working very hard on right now. Somewhat larger in dollar, but very similar characteristics. And so we have 2 transactions that we're focusing right now. Both of them are preferred equity. Both of them are with an existing relationship that we have, Joel Schwartz of Brooklyn, New York, a group that's been around for over 30 years. And with them, we're looking to do 2 transactions. One of them is going to be $18 million. The other one is going to be somewhere in the $16 to $17 million. Other 2 transactions that we've finished right now are equity transactions. In fact, we just finalized the second round of an equity transaction that we'll talk about in a little bit. On common equity with a local group over here. And we're going to be starting next week to do the second round of our raise for the 350 unit ground up rental in South Florida. If you look at the overall originations that we've done today, it depends on various years. In some years, we've reached as many as 664 deals that we had to go through and analyze and kind of like pick the right ones. Again, we say no to about 98 transactions. They're all of the transactions that we see, and we close somewhere in the vicinity of about 1 or 2% of those. So 98% of everything that we see, we say no to for a variety of reasons. Give you a nice snapshot of where we are on the geographical matter. We did deals in Chicago, Illinois. We have assets in Phoenix, Arizona, Dallas, Fort Worth, Tampa, Dania Beach, South Florida, Ohio, New Jersey. Lots of concentration in specific areas of Brooklyn, New York, Queens, Manhattan. We had just 1 transaction here and there, so including New Rochelle as well. I would say that today, a lot of our concentration is going to be around Brooklyn, New York, which is a booming market, a very, very solid market. New York City in general for renters is, it's a very tough area to find an apartment. The vacancy factor is around 2%. Rents are skyrocketing, and the demand is very, very strong. We're shying away from certain aspects and certain areas of Manhattan. We're shying away from certain deals that we see in Queens, but we're still going very, very strong. In Brooklyn, we're seeing the demand not just in rentals, we're also seeing the demand for condominiums. There's been a very interesting shift. A lot of the flair and the beauty and the kind of like the demand that was in Manhattan is now started to shift towards Brooklyn, and we've been seeing it for the last couple of years. Of course, South Florida is a market that we're very active in. Again, we'll talk more about South Florida because we are starting to see more and more of a shift. And I'd like to acknowledge some of you here that are sending us also market details. Eric Braun, in fact, sends me very consistent market details. And we always sort of like look at things, but we also do a lot more deep dive about the markets that we're participating in, just to be ahead of the curve and just to kind of like keep our fingers on the pulse. And let's talk about what's important to all of us. Tariffs, right? Everyone's talking about tariffs. Where are things going? What's happening? Trump, China. The reality is, we're trying to create, what Trump is trying to create is trying to create a balance of trade, right? In itself, it's a good thing. The question is, how is it getting done and how is it getting implemented? And truly, what is going to be the impact on the economy, the local economy, and of course, what's the impact on what it is that we're doing here in commercial real estate? So, we read the articles, we do a lot of our own research, but we really are interested to hear from the street, right? We're interested to hear from local contractors, the larger contractors in various markets. How are they planning to avoid all sorts of spikes, right? We know that there's been a big impact on tariff on steel and a big impact on tariff on aluminum. There's going to be 25%. There's been a bunch of shifts between tariffs. We're seeing that obviously a lot of countries are coming in and they're trying to negotiate. There's probably going to be a deal soon with India and other countries as well. Obviously, everyone's looking to create balance, right? A balanced economy and a balance of trade. And we feel that, what's the impact on the projects that we have and how much of a cost do we have to reserve, how much additional we have to put aside in order to find ourselves in a safe position as things are shifting. So ultimately, we have 5 major areas where we're focusing on tariffs. So the first one is the impact on construction costs and how is it going to affect some of the projects. So all of the projects that we are right now, without exception, are already bought out. So what does it really mean? It means that when a contractor goes and bid for a project, he does his negotiation with all the subcontractors, the major subcontractors, the electricians, the plumbers, the cement guys. He does all those things, and then they start doing what we call purchasing. We start to purchase all those positions, all those sub positions, signing contracts with all those subs. Just imagine it's an entire universe of individuals that are working, everyone, trucks coming in, material comes in, all that good stuff. You can go to a project and only find out during or along the project if things are changing, if cost is changing. And so what you do is you sign those contracts. So we call it in industry, you buy those contracts out. And so all of our contracts that we're in right now have been bought up, maybe one exception, which is maybe 90% brought up, and there's no big anticipation for changes. And that's an important thing for us, because trying to price things today, specifically when we know that there's going to be some impact, it's going to be fairly tricky. And so one of the things that we do, and this is something that Andrew and Alex is very good at, is they add additional reserves, additional layers, right? Some percentages that we add just to be on the safe side. So if a project costs $50 million, we look at some of the line items and we'll add some additional reserve in order to be on the safe side. Overall, there's been a lot of noise about how much of an impact it's going to be on the construction itself. Mostly what we've heard are 3 to 5%. So future projects, and not that people know for 100%, right? Future projects, we're looking to 3 to 5%. Some instances we see lower amounts, more like in this article here, 1 to 3%. And on specific items such as wood frame constructions. But since what we do is more on the institutional side, we deal with a lot of cement, we deal with a lot of steel, we deal with a lot of aluminum. We're putting a little bit of a higher contingency, 3 to 5%, specifically on certain line items. The other thing is, since 2018, a lot of the large builders and a lot of the large contractors and a lot of the large procurement sections of the construction industry have started to create a shift, have started shifting away from China and into other markets where they found a lot more stability. The case here with the estate companies, we have 704 units in 2 different projects, 350 units in one, 354 in the other. There's been a lot of the purchasing been shifted since 2018 away from China and into other markets such as Turkey, such as India. And it seems to be the right approach for things. A lot of the vendors, and we're seeing it now, specifically now, a lot of the vendors are in the last quarters, the last several quarters, last several months rather, have been buying a lot of product and sort of like storing it away in anticipation for impacts of tariffs. So that has actually have caused some kind of an impact on our GDP, which we'll address in a moment. But overall, it's manageable. The impact fully is unclear. It is manageable. If your project is fully bought out, then it's not going to get affected. And really, I mean, we'd like to believe that things will sort of like settle and settle fairly quickly. But as we always say, we have to believe in the best but anticipate the worst. So we do that in our analysis. Whenever we go into a project, we create the additional reserves in order to accelerate our project. Potential of a recession. Again, conversations about recession started to creep up again because there's a lot of unknowns, because people are not sure, because the economy is sort of like going sideways. We've seen it in the stock markets. We've seen the spikes. We've seen the drops. Every news and every piece of information coming out of the White House and coming out of Trump or the administration is sort of like creating some kind of an impact, and we're seeing those shifts. But I think overall that things are overall the overall environment is fairly well. If you look again, the areas where we pay a lot of attention to is of course inflation and employment, right? That's what really triggers the Feds in order to spike interest rate, keep interest rate, or drop interest rate, right? So those are two main things that they always look for. And the two main things that they truly are in charge of is employment numbers should stay high and inflation should stay under check. And so altogether, we're still looking at, even in April, at around 2.4%. The numbers will come out. But around 2.4%, which is again manageable. Again, the last 2% are very sticky. And employment numbers are stable, very, very stable, and stable considering quarter over quarter. So a risk of a potential recession. I mean, I personally don't think so, and I'm listening to a lot of talking heads and a lot of smart people, and we're listening to a lot of opinions. There could be a little bit of a slow of an economy, and if something should happen, it's going to be sort of like a very soft dip. I always like to remind people that when we're talking real estate investments, we're talking conversation into the future. So going into a 2-3 year project or 4-year projects, we're going to find all sorts of cycles, right? We're going to find a low cycles, we're going to find a peak cycles. So we have to be able to sort of like anticipate what things are today. We always mark to market. We always actually look at market conditions today. We make our decisions based on that because truly nobody has a crystal ball. So there's a certain amount of uncertainty. What I do think is going to happen is that, again, the institutional groups, and today we sat down with one of the largest developers here in South Florida, a group that's very, very well known. We had a very interesting conversation. But of course, I've been asking them the same questions, what they feel about tariffs and what do they see in terms of capital in the markets. And a lot of the institutional groups and a lot of the institutional capital is, again, on the sidelines. Uncertainty for institutional capital means that they sit on the sidelines. They don't want to make decisions. Think about who makes those decisions. It's individuals that are being hired. And if they make the wrong move, essentially it's their job, right? So there's no entrepreneurial risk for the institutional groups. They're very heavy to move. There's been a good amount of activity last quarter of 2024. And because of the uncertainty that is now happening, mainly around the issue of tariffs, then there's, again, institutions are, for the most part, sitting back on the sidelines, getting ready to deploy capital. There's mountains of capital. There's a big pent-out demand to put money out, but they'll only do it when they feel that the coast is 100% clear. And so institutions usually comes last and leave first. That's what I can say about tariff, and we can talk more about this, but I want to say that, for us, instead of sitting here and guessing and trying to figure out how things are going to go, we look directly into each and every project and ask ourselves the question, do we have risk? If so, how much risk? And as I said, the projects that we are essentially projects that are being bought out. The equipment has been bought out, the trades have been bought out, and so we're doing okay with those. We do have to keep an eye very, very closely and put enough of a contingency going forward on future projects. GDP, which is a big conversation right now, this quarter, GDP has dropped. I think that this particular slide is a bit misleading because it shows as if the GDP has dropped to by -3, which it did. There's been a small drop in the GDP from previous quarter from 2.4. And so a lot of it has to do with the forward purchase of all materials, right? Such as steel, such as lumber, such as cement. A lot of the large groups and a lot of the large investors, all materials in all cases, in anticipation of tariff, have been buying a lot of goods that created essentially a bit of a dislocation between export and import because there's been a lot of imports, again, in anticipation of tariffs. And so we're seeing that impact on GDP. So we're seeing a small negative growth in compared to previous quarter. And of course, with everything else that's going on, less government spending that also has an effect. If you would think about the overall concept, I think that the year will end up very positive because a lot of that material has already been called for, is being waiting to be purchased, and so the economy is going to show a very nice expansion because all those materials are not going to stand in place. The other areas that we pay a lot of attention to, economies pay a lot of attention to, is of course how spending is being done. And spending has been sort of also very stable, and that's obviously has to do with velocity of money. And a big part of our economy is the velocity of money, how much we're spending. And that seems to be very stable. So again, from our standpoint, we're looking at good fundamentals. Certainly, there's a good amount of unknowns going forward, but we'll try to keep positive outlook when it comes down to it. We'll talk today about three assets throughout our portfolio and do a quick overview. So again, for those that are participating in those deals, and for those who are not, they'll give you a quick glimpse. Of course, if you're in this deal, then you have the full report from us. The first one that we'd like to focus on is the Caesar Republic. It's a project that we've started about 3 years ago. We participated with a group that's based out of Phoenix, Arizona. That has about 40+ years of construction experience and hotel development experience, hotel ownership experience. We've been looking very closely into the Phoenix area and saw a fantastic market, a market in very high demand. It has all the fundamentals that we were looking for. We saw a big growth, both in employment, a big growth in population, specifically in past pandemic and during the pandemic. And with it, we got very, very interested in this market. But we also saw something else. We also saw an oversupply and a big, big tsunami of oversupply of units, of mainly on the residential side, a little bit too much also, in our opinion, on the industrial side. But we knew that the market is going through a very, very positive shift. And so we found this project and we found an amazing group, as I said, that's been around for over 40 years, almost 45 years. And their focus is the hospitality and multifamily. That's the only two asset classes that they build and own. We partnered up with them on a project in Scottsdale. Scottsdale is sort of like the affluent section of Arizona, and to build 265-key hotel. The project is now being valued at $206 million, most recent valuation. good amount over what we anticipated the project to be, and generating for us on an Astor level 33.2% annual return. What's unique about this project is that Caesar is the brand of this hotel. We have a lot of food and beverage, but Caesar came in, and Caesar is essentially became the brand of this hotel. It's the first non-gaming hotel in the United States by Caesars, and it's really a fantastic brand. Over the course of the first 6 months, we realized that Caesar needed a little bit more of a push, because Caesar's essentially reservation system is fantastic, but is also very much geared towards individuals that are coming to Vegas or coming to Atlantic City to play, right? These are the folks that are coming to the casino and stay at a hotel, enjoy the hotel, but come to the casino. And so we've done something that in the history of Hilton, and certainly in the history of Caesars, has never been done before. Our partners brought both brands together to cooperate and to operate as a co-brand, which is something that's very, very hard to do and very unique. He was able to put this project together and bring Hilton to assist us also in the reservation system. So a dual branding, it's a very rare situation. Caesar just simply loves the hotel. This is like something that they all-heartedly negotiated to stay there and requested to stay there, and they sweetened the pot. Hilton came in with over $4.5 million themselves just to sort of like bring into the deal. It's something that hotel brands sometimes do when they really like to be part of a project. And we finished the hotel. I think it was last year in March 6th. It's going through a ramp-up period. Hotels go through a ramp-up period, and I think we're doing really well. What's unique about the hotel is that we also have a good amount of food and beverage. The food and beverage itself, so outside of the rooms, right, outside of the room revenue, the food and beverage itself is anticipated to generate around $26 million. We have Luna by Giada, which is a celebrity chef that's running the restaurants, more than restaurants, and some of the lounge area, and doing extremely well. And she's became a huge destination for folks in the area over here. And we are now signing up Lisa Vanderpump. So Lisa Vanderpump is a known celebrity. She was in major TV shows, Housewives of Beverly Hills, became a very big brand, have been a very big brand, and now she's going to be taking over on the 7th floor, which we have this amazing space next to it. We have two pools, and there's a pool on the 7th floor, and that's going to be facing sort of like the open desert area in a place called Camel Mountain, Camelback. And that's going to be essentially her lounge that she's going to run. It's going to be very, very classy, and that's going to happen right after the summer, right? So we just signed Lisa Vanderpump, and she's a very, very big deal. In terms of our timeline, just to give you a snapshot of where we are, the construction, which is something that's quite rare in projects. The construction, at the top you can see the current, and the original is at the bottom. Construction actually took us less time, took us 24 months to build this 265 keys. We're talking about close to 400,000 square feet, and this is quite complex, right? Just think about every room and food and beverage and all those different things. 24 months from the moment we hit the ground. The anticipation was to do it a little bit longer, to do it in 30 months. We're very happy about that. Stabilization is dragging a little bit more. However, we're hitting the numbers, and we're surpassing on the food and beverage. And what we're doing right now is we're coming out of the construction loan, and we're coming out of the mezzanine loan. Both of those are combined, are going to be taken out with a short bridge that will lead us to stabilization. Anticipated exit is Q1 of 2026, and as I said, we're doing a little better than what we've anticipated in terms of returns to our investors. Again, keep in mind, this is mark to market. So the team sits down on a quarterly basis, and we base on what is happening, right? What is happening, we do our projections. We started with a projection of around 25.4% annual return. We're looking at around 33%, 33.2 annual return based on today's numbers. Because the project went quicker because we're seeing higher amounts from the food and beverage. I think we anticipated food and beverage to be around 14 to $16 million. We're around 26, and it's just unheard of. So I think the team on the ground did an amazing job. And mark to market the asset with a forward NOI of $14.6 million at an exit cap rate over 7. We're looking at $206 million. So I used to say before that we feel that the appraisal came back. We felt that the asset will trade around 167 million, 170 million, and we felt that the appraisal was a little bit too aggressive. We're starting to now warm up to the idea. At around a 7 cap, this thing will sell all day long for a much lower cap rate. So we might even have a positive surprise even over those numbers. The second project I want to focus on is also a very interesting project, the boutique condo that we have in Gravesend, Brooklyn, New York. We do a lot of projects in Brooklyn, pinpointing the exact location, the right locations. And we have a project over here with 12 luxury apartments. Total stabilized unit, total stabilized sales is expected to be $61 million and around a 35%, 35.2 annual returns. What can I say about this project? I think the most important thing, without going into too many details, is that we looked at the microeconomics of this neighborhood. This is a neighborhood that is predominantly occupied by the Syrian Jewish community. It's a very, very affluent community. And we've noticed a couple of things, that they are, God bless, many, many kids, not enough housing. The second thing we've noticed is that it's a captured audience, because during high holidays, they will not drive, they will not get into a car, they will not get into any public transportation. And so everything that is going on in this neighborhood has to be done in a walking distance. The third thing that we've noticed is that obviously they're very, very, I should say, clannish. Okay, so everybody likes to live next to each other, the sisters and the cousins, and everybody lives over there, and they're they're doing very great. And so it was tough for us to find comparables. But there was one comparable, which was about 2 blocks away from where the site is. And in that particular area, I'd like to say that the one comp that we had was a building that was very inferior, very compared to this one, around 13, 14 years old, 50 units, nothing special, and he was trading for dollars per square foot was pretty high. It was like $1,800 per square foot. We didn't want to underwrite with those numbers. We decided to underwrite a lot more conservatively. So you can see over here in the pre-sales, we're underwriting at 1548, or call it 1550 per square foot, 1,550 per square foot. We're actually averaging 51.6% higher. It's quite shocking to all of us. Our average sale price is on dollar per square foot is around 2,347. So those of you who are in this project, I think you're going to be very happy, because we're looking at much larger numbers than initially anticipated. You can see the timeline over here. The project is just about to get his certificate of occupancy. Alex just told me that we're 95% there. There was a second round of the city department to give us the certificate of occupancy. So we're somewhat on time on the project. There's been some deviation in the early part of the project coming out of the ground to the planning phase, but I think it was designed. I would think those extra months that we've took for the planning phase were for the right way, because that's the reason we're seeing today, because we hit it right where it makes a difference. Okay, yes, we're expecting to receive TCO within the coming month. We have a number of units that are under contract, and individuals are waiting wholeheartedly to move in. And so happy to say that at this stage, with the number of sales, we have 5 sales, 7 remaining units. There's a good amount of interest around those units. As I said, the inventory is very, very low in this area. Once we'll close with the certificate of occupancy, we're we're going to pay off the loan immediately, which is very nice. And then the rest is going to be hopefully smooth sailing towards the end of the project where sales, when it's nice to know that you don't have a mortgage anymore, right? So the way it works in condominiums, every unit you sell goes towards the reduction of the mortgage. We have enough here in contract to pay off the mortgage on the day that we receive the certificate of occupancy. Projected returns at this stage, we're looking at 35.2, and I want to say that we're going a bit conservative, even more conservative than what we're seeing right now. So while we're seeing 2,300 per square foot, we're still underwriting a little bit lower than that, at $2,200 a square foot, just to be a little bit more conservative. Maybe we'll need to give a concession to somebody, maybe somebody will ask for a discount, all sorts of different things. This gives you a picture. This is about, at this point, I think about 2.5 months old. We'll just give you some quick shots, no more renderings, but rather quick shots of the inside of the project. The last project we'll discuss today, we'll do only 3 projects per GlassDoor. The last project we'll discuss today is a project that we finished, I think it was August of last year. It's called Elevate at Dania Beach, Florida. It's sort of like the South Miami, South Florida. Sort of along one of those neighborhoods that is nestled outside of Miami, outside of Fort Lauderdale. Both very, very expensive markets, very, very lucrative markets. And so in between, you have a few beach towns that are sort of like becoming very popular because not everybody can pay, $8,000, $10,000 for a 2-bedroom apartments. And so we're seeing more of that push. And that's the philosophy of us going forward in terms of investment. But here's a project that we've recently completed, the construction completed. We got the certificate of occupancy in August, and we are at 293 apartments. It takes a while to lease those apartments. Our average month lease up is about 25 units. In some months, we're leasing more than 30 units. That's more than 1 unit per day. And the numbers are good. The numbers are really good. We'll take a look at this for a moment. Right, the numbers are doing pretty well. We're $3.51 per square foot. Okay, so in Florida, for those of you from New York, in Florida, it's kind of like we discuss things monthly. So in New York, that will be the equivalent of, call it $42 or something around those. Yeah, $42, about that. And so still very much affordable. Average rents around $2,800 per square foot. We're giving some concessions. But again, the lease up period is going very, very nicely. We are a couple of minutes from the beach, call it 10 minutes to a major business district. And so things are going pretty well over there. Our position in this project is preferred equity. Unlike the preferred equity positions that many of you here on the call are familiar with, where we make distributions on a quarterly basis, it's the first preferred equity deal that we've done. And so we've accumulated the entire preferred towards the back end. The investor's return is 16.3. The overall return to the company is around 19 or 19.2 is what we're anticipating. So obviously not a lot of a spike on the upside because we're preferred, we're downside accelerated. But that's a project that we're expecting to exit. We're saying Q4 of this year. But judging by some of the recent conversations, it's going to be sooner than that. I'd like to speak a little bit about the South Florida rental market and the South Florida market as a whole, because I've been getting a lot of questions about South Florida. We're obviously very busy in South Florida. What's going on? Where things are going? And so, I mean, we're looking. There's a couple of things. We read like everybody else. We read the headlines and we track all the information, but we look for the numbers, right? Newspapers are designed to sell. The social media is there to create sensation, to grab our attention, but then we have to sort of like sift through all this stuff and find out exactly what is in fact happening on the street. So the first thing that we look for is to see what's happening in terms of deliveries and in terms of absorption. If you remember earlier in the conversation, we spoke about Phoenix, Arizona. Phoenix, Arizona, we looked at deliveries, right? How many projects are actually getting started? When are they expecting to complete? How many units are going to be available? And really what sort of an absorption there's going to be in order to occupy those units, whether it is homes, whether it is condos, whether it is rentals. When we've done our analysis, we sort of like said, so hold everything. The amount of deliveries and the amount of units coming online is tremendous, and we don't believe that a market can absorb such a tremendous spike in units. And so we've pivoted and moved away from the multifamily and focused on something that we felt was very much in demand. In this case, it was the hospitality. In Florida, we're very much focused on deliveries, and we're very much focused on absorption. As you can see on the top right side, absorptions in South Florida is higher than deliveries. Okay, the numbers are higher than deliveries. The demand is larger than the supply. That's the kind of a market we want to continue being. And you can see over here occupancy. That's a little bit, just maybe a quarter or two old, but occupancy in all the submarkets that we're tracking, or anywhere from going as far north as Boca Raton, and all the way down to Kendall, and the areas of Homestead and South-Dade County, all those areas, we're trending in the 90s, right? In the low 90s, 93%, 94%, in some instances, even higher than that, such as Hialeah and Miami Lakes, not a market that we love too well. But altogether, we're looking at a very healthy markets. This obviously represents all units, all buildings. This is a count of buildings that are at least minimum 50 units, but they can be, 50, 60 years old. And then you have to sort of like dissect the absolute market that you're in, focus on the mark to market, which those of us here, when you see our presentations, you know that our team does that. And so let's take a look and look a bit of a closer look. So the sensation is condo markets and inventory in the condo markets, especially around South Florida, around Miami-Dade, is increasing. It's absolutely the case. Miami-Dade is now seeing a lot of units coming online, whether it is in pre-sales or whether it is being delivered. A lot of units, just thousands of units. I think the number, if I'm not mistaken, was around 14 or 16,000 units that are currently on the market. We're seeing that it's kind of like it's lingering, right? It's going through a lingering period. Around 80 days on the market was, if I'm not mistaken, this time last year. This time around, we're talking about 100 days on the market to sell a unit. And so that inevitably, and this is something that we've been tracking for the last 2 years, right? It's not new to us. We've been seeing a drop in activity, mainly related to spike in interest rates, right? So we're seeing a drop in activity, and a lot of it has to do with it. But now we're seeing other things that are sort of like coming on as well. So if before the major or the dominant factor was a spike in interest rate, which made it tougher and made money a little bit less available, now we're also seeing a change in insurance, which is quite higher. It's about 25% higher than anywhere else in the United States. So insuring a home is a little bit more expensive. And other issues, all right, in some of the older product that is sort of like, dragging the market down. Some of it has to do with new regulations that came in because of Templin Towers. Those are familiar, the tower that fell at 1 o'clock in the morning and unfortunately killed 101 individuals right here in Surfside, not too far from where we are. And so between, HOA that are sort of like pushing up against putting more capital into the buildings, between increase in insurance, between inventory that is rising and everything else that's going on in an environment of a high interest rate, it is just normal for us to expect that things will go slower, and ultimately we'll start seeing some breaks in price. And we're finally starting to see some breaks in price. The overall price break right now stands at around anywhere from 2 to 5% on average on transactions. Transactions are happening. There's a lot of thousands of transactions are happening, but there is a little bit of a price break. Does it mean that the market is over? No. Does it mean that Miami is over? No. Does it mean that people should be running to the hills and everybody should start selling? Absolutely not. As long as the interest rate is going to stay at a 6.5%, 7%, that's going to be the most important factor. That's the determining factor. When we think about insurance, spiked. It spiked by 25%. People can absorb it. HOA, people can absorb it. Not everybody can absorb it. I don't want to paint everything with a broad brush. But the biggest factor, in fact, is that. Now we're seeing also somewhat of a shift between new population that's coming into Florida. In the last quarter alone, we're looking at around 3,000 individuals that came in from Florida, California, Colombia, Venezuela, Cuba, and New York were the major areas where population came from. So around 3,000 individuals. That means roughly about 1,200 units that are needed, whether it is to rent or whether it is to buy. But all those individuals, they need services, they need school, they need places to work, they need a place to live, and so on. There's still a very, very strong demand for Florida. It used to be Texas and it used to be Florida. Right now, I think Texas is third place, Florida is fourth place, and other states, I think North Carolina is actually taking the cake. Again, a lot of the individuals that are coming here are coming with very deep pockets, and that's maybe one of the differences as compared to other places as well. Couple of other points that I know that Alex have brought up, some issues that have been with Fannie Mae. I think maybe not so much relevant to our conversation, but there's been some issues with Fannie Mae. Some of the old condo buildings have been blacklisted because the HOA is not enough there to kind of like keep the units at or keep the building at the kind of conditions that they wish. That also has an impact. All of those things leads to one thing for us, which is less people buying condo units or buying homes, the more they'll need to rent. The more they'll need to rent, the more we want to be renting them apartments. Again, we want to shy away from very, very expensive units, and we're going with the same philosophy. The demand is there, all the environment is there. We just need to provide what we call the affordable luxury in order to catch the majority of the demand, right? So the majority of the demand wants to live in great housing units and have great amenities and be fairly close. Doesn't have to be right there, but have to be fairly close to lifestyle, to employment, and to access to all the other services that are important. Based on that, I think that our philosophy is sort of like meeting reality today, more so than ever before. The less people will buy, the more they're going to be renting. And so the demand for rent and with it, rents will continue to increase. Wanted to open up to some questions or any comments from everyone. I've been talking for a good 40 minutes. So any questions, happy to address them. Okay. And so Laura will share with you this presentation so you can have it, you can share it with your friends. I'd like to invite you next week. We're going to be starting the raise for round 2 of our multifamily project in Davie. Davie is, again, 30 minutes away from Miami. And it's located just about 10 minutes away from Las Olas. And in this particular project, we're doing the project with the estate companies. The estate companies is the second largest by volume and sheer size. A developer in the Florida market, specifically in the South Florida market, been around the block for over 40 years. With them, we're embarking to do a number of projects. This is a self-performing general contractor that is uh, doing an amazing job. That's right. So not only they put money and they act as developers, but they're also self-performing contractor. It's a company composed of 100 individuals, and they are absolutely masters at what they do. This is the second phase of, I'm sorry, I shouldn't say the second phase. This is round two of our raise. The way we have our raises, in this particular case, we're building 350 apartments. And we cut the check, which is around $36 million, $35 million of equity. We cut it into two tranches. So this is tranche number two. This project has about 31 months left, and you will generate the investors between 22.6 to 26.3% return. That is net to you, the investors projected, net to you, the investors. We can talk more. We'll talk more about this next week. I'd like to invite you all, take a moment, scan, register, grab a spot, and we'll talk more about why we feel that those numbers are very solid and why we feel that we can beat those numbers. Where do we get the confidence for it? We'll talk more about that stuff. It has a lot to do with what we said earlier, the impact on all those other areas that are preventing people from buying homes. With this, I want to thank you all for
So
joining.
just before you wrap up, Joe, we do have, if you can check out the chat section, and we also do have a few people with their hands raised for some questions.
Okay,
I'm
let
gonna
me just,
call upon if that's okay with you.
yeah, can you read it off? Because I can't see it in this presentation. Why am I not seeing it?
Let me stop share for 1 second, and that might
Yeah,
help.
that's better. Okay, now I see it. Okay, here we go.
Yes, and whilst you check that out, I'll call on Robert. Robert, hi, how are you? I've just allowed you to talk, so you can unmute yourself.
Hi, Joe. How are you? Laura.
Hey, Robert, how are you?
Good. I did get on 5 minutes late, and maybe I missed this, but did you speak about Miami Legacy at all? Because it was supposed to be part of the presentation.
We haven't touched Miami Legacy, and I can say that with Miami Legacy, I expect to exit again. I expect that we should exit this project, either exit the project or replace position within the next, call it 45 to 60 days. I can't go into a lot of details, and that's the reason we decided not to speak about it. We're in the midst of a negotiation right now, but there's been a lot of interesting moving parts in the last couple of weeks, and I think that that will be a very, very positive thing for the legacy, a very positive thing for the developer himself. Okay, so
Thanks.
it's yeah,
Yep. Thank you so much. I appreciate it.
absolutely.
We also have Susan.
Okay.
Hi, Susan.
Hi, everybody. How are you?
Hey, Susan, how are you?
I'm so happy to have you. Hey, Joe, how are you doing?
Doing good.
I thought 3051 Atlantic was going to be in tonight's presentation, so that's why I typed those questions in. But since I have your attention,
Mhm.
so it's past, the raw material, needing raw material. You've already got the plumbing, the HVAC, all the rough is in, and so on. So.
Yeah. Mhm.
What, if anything, is going to impact in terms of tariffs, the prices of what's left there? For the finishes and such, are there, all that stuff has been pre-ordered, no?
Yeah, I mean, in this particular projects is very, very close to being complete.
Right?
It's beyond the purchasing. It's at this point,
Right.
it's actually in place.
So that project shouldn't really have too much impact with tariffs, right?
I don't know. We don't think that there's going to be an impact. A lot of it has been purchased, and it's so far advanced that there's nothing really. I mean, listen, there's always can be something, but there's nothing really that can have a negative impact on it. At the same time, we're accelerated because if there's going to be a shift, if there's going to be $1 million shift, it's really the developer. It's on him. It doesn't impact us.
Uh-huh.
So, what Susan is referring to is a project that we're doing in Brooklyn. It's one of the preferred equity projects. And it's a very, very late stage. So I'd say, Andrew, you
Yeah,
spoke.
we're actually you'll
Mhm.
probably be receiving the quarterly report tomorrow, Susan. We're actually almost finished with that building already. You'll be very. I know you. I think you live in Brooklyn, so maybe you won't be as surprised as others. But the progress from last quarter's report to this
Yeah.
quarter's report
Mhm.
is tremendous, and you'll see that the building is actually almost complete. We're probably only about 2-3 months away from TCO, which means,
Oh,
yeah, as Joe
wow.
said, we're very, very good on the cost. We don't have a lot left to spend. Right now, they're down to kind of, final inspections, checklists, things like that. So we're in a great position there, as well as the Fulton deal, which is a very similar deal that, some may be familiar with. That's also in a very good spot with regards to any potential cost increases.
Fabulous.
Mhm.
So I want this going on record that I want to be on site to crash a bottle of champagne when you're ready. I will be there.
Sounds good to me. We'll do it together.
All right, great to be here, gents and ladies.
Good to hear from you, Susan. So yeah, but again, I mean, remember, as also in terms of tariffs, we push back a lot on that stuff on the developers. So if there ever, not in every project, of course, but if there's ever a situation like that, and there is some sort of an overrun, the overrun is on the developer himself. Um, yeah, in regards to legacy, I want to say it again. We're very, very deep in negotiation right now, and I'd rather not speak about it. We'd like to see something signed, and I think it's going to be fantastic for all of us. The legacy is, again, it's a project that is a preferred equity project, so our interest is kicking. There's no distributions, but the interest is kicking along the way, and so we've anticipated to exit this project by the end of this year. That's where we have it on our books. And I think it's going to happen sooner than that. And I hope it's going to happen sooner than that. At the very least, we're shifting position. And I can't go into a lot of details because it's very, very, very delicate. But as soon as I can, we're going to issue a report to everyone and we'll bring you up to speed. So we don't have to wait for the full quarterly report. We'll do a sort of like a breaking news sort of an idea, and it's going to go to the individuals that are investing in it. We're at 6:30. If there's any other questions, happy to address them.
Joe, I do have Irv Braun with his hand raised. Irv,
Mhm.
you're able to talk.
Yeah, hi. Hi,
Hey.
Joe.
Hi.
A quick question. In the portal, there's something about a new deal. It says F&F in Brooklyn. What's F&F and what's the deal possibly?
F&F Irv stands for friends and family.
Oh,
Uh-huh.
And I believe
I didn't even know. Maybe we should spell it out because I didn't know what F and F means. Laura,
and I'll take that on board. And I believe that you
appreciate it.
about three building portfolio, Joe.
Oh yeah. It's an interesting deal that it's an interesting deal, a little bit different. This is a portfolio of existing buildings, so there's no construction. It will be a 2-year deal. Right now, we're in negotiation to bring an anchor because it's a 16 or $18 million preferred equity position. So we'll need an anchor with us. We're in negotiation with one group right now. It's a REIT, a very well-known company. They gave us a proposal today. I'm not sure that their proposal is sufficient for us. But as soon as we're done with the anchor position, we'll be able to go out to our F&F. Now I know what F&F is. Now we'll go to friends and family and we'll do our normal raise. But it's it's a nice deal. It's a nice deal. 3 buildings, 204 units. It's about a year old. 3 buildings about a year old. It's in Brooklyn, also with Joel, and it will generate nice income for everyone. And we'll also create a quarterly distribution, so we liked it, and I know it's very popular with everyone. And so that will be the next deal that's coming. I'll probably say we'll probably start another 30 days, 45 days, maybe 60 days to start with the friends and family side of the race. Yeah.
Thank you.
Thank you for the question, everyone. Very great to have you here. And looking forward, if you can make it next week, we'll talk about round 2 of the Celeste Reserve project. Okay, 31 months. We're looking at 22 to 26% annual return net to you. Exciting projects. It fits exactly to what the market needs. People cannot buy apartments, or they don't want to buy apartments, or it's expensive for them, or being too close to Miami or Fort Lauderdale, too expensive. Here we are. We're offering an amazing product, institutional size, quality, and an amazing, amazing local partner. Thank you very much, everyone. Thank you guys from Astor, and we'll see you again all next week. Take care.
Thanks all
Bye
for
now.
joining us. Have a good afternoon. Enjoy the rest of your day.